Guys and girls, welcome back to another Boom on the Outlooks video, and today we're covering what are technicals and why do we use them. Now, what are technicals? As we know, fundamental valuations takes the first limelight when it comes to knowing what is undervalued and overvalued within it. Without a fundamental bias, price would stand still. There is a reason for every singular move in the foreign exchange market. Behind all volatility, of course, is a catalyst. Now, technicals refer to the analysis of past market data, primarily price and volume, to forecast the future price movements in your favor. Technical analysis involves the study of charts and patterns to identify trends, cheap and expensive areas, and potentially reversal points in the currency pairs. Now, put simply, technicals simply allows us to trade and translate our bias into a live contract within the market, as we aim to buy an undervalued cross or sell an overvalued pair. A very common three-step process to remember is the following. First, you understand your strong versus weak economies. Secondly, you understand where they were confirmed cheap, so the absolute monthly and weekly lows, and where they were confirmed expensive, the absolute monthly and weekly highs. Understand where the next confirmed area of cheap is, which is the last area of daily demand, and where the next confirmed area of expensive is, which is the last daily area of supply. Now, why use technicals? The premise of technical analysis is that historically, price movements tend to repeat themselves, and certain patterns or signals can indicate potential future price movements. While technical analysis is widely used in FX trading, it is important to note that it's just one of many approaches. Without fundamental analysis, it is largely useless. Now, below is the benefits of utilizing technicals once you've acquired your fundamental bias. So firstly, it helps you objectively make decisions. Technical analysis relies on quantitative data, which can provide traders with objective criteria for making decisions. Now, it can also aid in short-term trading opportunities. Technical analysis is particularly well suited for identifying short-term opportunities because it focuses on the price movements over relatively short time frames. Now, looking at timing your entries and exits, of course, technicals provide tools for timing when you get in and when you get out the market, which will potentially maximize on profits whilst minimizing losses. Of course, risk management ties into your technical approach because it can assist in managing risk on all elements by providing traders with tools such as stop loss orders, which are based on key areas within the chart. Now, of course, it's not only relative to FX, it is applicability across market within your portfolio, or it has the applicability, I should say, which of course, technical analysis and its principles are applicable across numerous instruments. So it not only allows you to trade FX, but of course, if you see opportunity elsewhere, you can apply the same principles. Now, this versatility allows you to apply the same technical analysis or the same analytical approaches on different markets, which can broaden your scope for opportunity. Now, here's the risks of solely relying on technicals. First, it limits your view from a market fundamental point of view. In other words, technical analysis focuses solely on historical price and volume. Now, it often disregards fundamental factors that have driven that price, such as economic indicators, geopolitical events, central bank policy decisions. And if you're simply not aware of why price moved the way it did, then you're out of the loop as to where the value is being derived from and priced in from. Now, there is always a why behind every move, and you should know that why. Now, subjectivity is key here, and interpretation. We all have our own thinking and our own approach. Now, different traders may interpret the same data differently, leading to conflicting technical views, and this applies to fundamentals as well. And this is why it is vital to trade what you see and not rely on anybody else. Lagging indicators. Now, numerous technical traders are reliant on simply hoping the same technical pattern plays out over and over again, which means they're simply lagging behind current market conditions. By the time you've already derived your fundamental bias, the market may have already moved, with or without your technical needs. You must be versatile and plan ahead for where the next orders may fill. Now, one thing that is largely misunderstood in this market is overcrowded trades. Popular technical indicators such as buying at support, selling at resistance, I mean, we'd all be billionaires if it was that easy, right? Are widely followed by traders, leading to overcrowded trades and leading to areas of liquidity building up. Now, when too many traders are acting on the same technical path or the same thinking, it can lead to increased volatility and wipeouts of orders, such as stop hunts and liquidity grabs. Another very, very important understanding if you're only trading off technicals is your inability to predict market events. Technical analysis cannot predict the unexpected market events or black swan events, such as natural disasters, political unrest, or sudden changes in monetary policy or data prints. The examples above are factors fundamental traders are likely already positioned and hedged ahead of time for, in case such risk does arise. Now, technical-only traders are blind to the risks ahead of them if solely reliant on the chart in front of them. Now, of course, impacting your trading and implementing the technicals requires skill and experience. Effective technical analysis does require experience, skill. Just like anything else in life, you have to earn your stripes and put the hours in. It's ongoing, it's continuous learning, but the first thing to understand is if you know your strat and you set your rules, you will learn either way from there. Now, one thing that is largely misunderstood as well is that not all technical strategies are suitable for all markets. We have different conditions, and technical analysis works best in trending markets, as we all know, where price movements follow clear patterns. But in a choppy or range-bound market, technical analysis signals may be less reliable, leading to an increased risk of losses. And it's very important that you know where and when your technical approach is best suited and adequate for conditions. If not, you must adapt accordingly. Now, that is why technical analysis is important and essentially what technicals are. I hope this helped, and I'll see you in the next video.